Welcome back. We are standing at the beginning of 2026. If we look back at the past 24 months, one chart has kept every investor on the edge of their seat: gold. From hovering around $2, gold made a spectacular leap to touch $5.600 per ounce early this year. Meanwhile, the Oracle of Omaha, Warren Buffett, has remained steadfast in his philosophy, holding 0 ounces of gold. Is this the biggest mistake of his legendary career? Or are we simply viewing the market through the eyes of short-term speculators while he plays a much longer game? In 2025, gold experienced record-breaking growth of about 60 to 65%, far outpacing the 17 to 18% return of the S&P 500. By early 2026, gold maintained its position as the top-performing asset, while the stock market faced multiple corrections due to interest rate hikes and geopolitical volatility. Gold transformed from a safe haven into a growth monster. Let's put this into perspective with a real-world example. If you had invested $100 into physical gold at the start of 2025, your portfolio would be worth roughly $219 today. If you had put that same $100 into an S&P 500 index fund, you'd be sitting on about $118. That $100 gap is exactly why critics are claiming Buffett has lost his touch. In a window of just 2 years, gold didn't just protect wealth, it created it at a rate stocks couldn't match. But to understand why Buffett refused this massive profit, we need to dive into his eccentric mindset regarding non-productive assets. Buffett considers gold a sterile object. 1 ounce of gold today will still be exactly 1 ounce 100 years from now. It doesn't pay dividends, it doesn't create products, and it doesn't hire workers. In contrast, stocks, like Apple or Coca-Cola, are living entities. They work for you even while you sleep. Buffett famously said, "If you owned all the gold in the world, you'd have a giant cube that you could fondle, but it wouldn't do anything. But if you owned all the farmland in America, you'd have food for the world and an annual cash flow." However, his record isn't without surprises. In Q2 of 2020, amidst the COVID-19 chaos, Berkshire Hathaway shocked the world by investing about $560 million into Barrick Gold, a mining company. It was a rare moment where Berkshire touched gold. But the real lesson came just months later. They sold nearly the entire stake. This proved that Buffett viewed gold only as a temporary tactical hedge, never a long-term strategy. Throughout 2025 and 2026, as gold prices skyrocketed, the crowd was driven by a fear of inflation and political unrest. People rushed to buy gold simply because they saw it going up. Buffett, on the other hand, lives by the mantra, "Be fearful when others are greedy." When gold becomes the primary topic in every coffee shop, that is when Buffett feels the most uneasy. Buffett invests based on intrinsic value, while gold rises based on the greater fool theory, buying something today only in the hope that someone else will pay a higher price for it tomorrow. So, when we look at the final outcome, who is the real winner in this game? Let's be fair. In terms of short-term numbers for 2025-2026, Buffett lost to gold. He missed a chance for rapid wealth. But in terms of an investment system, he didn't fail. Buffett doesn't invest to win for 1 or 2 years. He invests to never lose over 50 years. He didn't miss the gold rush because he didn't see the price rising. He ignored it because it falls outside his circle of competence. To him, sustainable wealth comes from participating in the growth of the economy, not betting against the fears of humanity. What can we take away from this? 1. Understand what you hold. Don't buy gold just because it's rising. Buy it only if you truly need an insurance tool. 2. Stick to your principles. The biggest mistake isn't missing an opportunity. It's breaking your rules to chase a crowd and taking on risks you can't control. 3. Asset allocation. You don't have to be as extreme as Buffett. Keeping 5 to 10% in gold as insurance for your stock portfolio is a reasonable strategy for individual investors in this volatile 2026. Historical stats from 1926 to 2026 show that $1 invested in stocks grew to over $15, while $1 in gold grew to only about $100, inflation adjusted. Gold may win a few turbulent years like 2025, but stocks win the long-term war of prosperity. Warren Buffett isn't wrong. He's just looking further ahead than everyone else. Don't let 2 years of gold growth make you forget 100 years of prosperity from world-leading businesses. Do you choose to own a piece of metal, or a piece of the future? Let us know your thoughts in the comments below.